IOU Nothings. Buckle up to uncover the invisible chains dragging our future into a doom loop. Hit that like, share, and ring in your subscribe or follow, because truth needs an army of awakened minds. We're going to look into the story of how modern currencies turned into what some call IOU Nothings. It's all about how governments around the globe have been spending without any real breaks, creating money out of thin air, and the massive risks that come with it. This isn't just some abstract economic theory. It's the reality behind inflation, debt crises, and why your money buys less every year. Stick around as we unpack the history, how it all works, and why it's so dangerous. First off, imagine a world where money actually meant something tangible, like a promise backed by gold or silver. That's how things used to be, but over time, that system broke down, leading us to where we are now. Currencies that are basically just government promises with nothing solid behind them. It's led to this endless cycle of printing more cash to cover wild spending, and the fallout has been brutal in places where it spirals out of control. We'll get into the nitty-gritty soon, but trust me, understanding this could change how you see your wallet and the news. Alright, let's jump into the full details. The roots of this go back centuries, but the big shift happened in the 20th century. For a long time, money was tied to commodities like gold. In the late 1800s, most major economies adopted the gold standard, where currencies were redeemable for a fixed amount of gold. This kept things stable because governments couldn't just create endless money, they had to have the gold to back it. Britain led the way in the early 1700s by accident, when they overvalued gold compared to silver, driving silver out of circulation. By the 1870s, it became the international norm, lasting until the early 1900s. But wars and economic crashes changed everything. During World War I, countries suspended the gold standard to print more money for war efforts. They tried to bring it back in the 1920s, but the Great Depression in the 1930s made it impossible. Britain ditched it in 1931, and the US followed in 1933 for domestic use, though they kept some international ties. People were hoarding gold, banks were failing, and governments needed flexibility to stimulate the economy. After World War II, the Bretton Woods system in 1944 tried a limited version. Currencies were pegged to the US dollar, and the dollar was convertible to gold at $35 an ounce for foreign governments. That worked for a while, but by the late 1960s it was cracking. The US was spending heavily on the Vietnam War and social programs, creating too many dollars without enough gold reserves. Foreign banks started demanding gold for their dollars, draining US stockpiles. In 1968, they created a two-tier system where private markets could trade gold freely, but central banks stuck to the fixed price. It didn't last. On August 15, 1971, the US ended dollar convertibility to gold entirely, known as the Nixon Shock. This effectively killed the gold standard worldwide, ushering in the era of pure fiat currencies. Money backed only by government say-so, not any commodity. Since then, every major currency has been an IOU nothing. No more promises to pay in gold or anything scarce. The Smithsonian Agreement in late 1971 tried to fix exchange rates with a bit more flexibility, raising the gold price to $38 an ounce, but without real convertibility, it failed by 1973. Currencies floated freely, and central banks could issue as much as they wanted. This shift happened because governments craved control to fund wars, welfare, infrastructure, you name it, without the discipline of a hard asset limit. Now, how does this actually work? The mechanisms behind creating these IOU nothings are sneaky but straightforward. Central banks, like the Federal Reserve or the European Central Bank, don't just print physical notes willy-nilly. Most money today is digital, created through banking operations. When a central bank wants to inject money into the economy, they use open market operations. They buy government bonds or other assets from banks, paying with newly created reserves. Those reserves let commercial banks lend more. Here's the real kicker: commercial banks create the bulk of the money supply through loans. When you borrow for a house or business, the bank doesn't take money from someone else's deposit. They create a new deposit in your account while adding the loan as an asset on their books. Loans create deposits, expanding the money supply. Central banks control this indirectly by setting interest rates, reserve requirements, or through quantitative easing, where they buy massive amounts of bonds to flood the system with liquidity. The value of this fiat money is all based on trust and force. Governments declare it legal tender, you have to accept it for debts and taxes. You pay taxes only in that currency, creating demand. But without scarcity, like gold's limited supply, central banks can overissue to cover government deficits. Governments borrow by issuing bonds, which central banks often by monetizing the debt. This is how IOU nothings multiply. A government spends more than it taxes, borrows, and the central bank creates money to buy those IOUs, turning them into circulating currency. But this system has huge flaws. Gresham's law kicks in, bad money drives out good. When fiat floods the market, people hoard scarce assets like gold, and the paper loses value. History shows fiat systems last about 24 to 27 years on average before failing, often through hyperinflation. We've seen 152 fiat currencies collapse due to this, with medians of just 7 years. Let's analyze the themes here. The core danger is undisciplined government spending worldwide. Without a gold tether, governments treat money creation as a bottomless pit. They fund endless wars, bloated bureaucracies, and entitlement programs without raising taxes enough, leading to massive deficits. In 2026, global public debt is hitting $111 trillion, nearly 95% of global GDP, up from pandemic-era spending and high interest rates. The US alone has $37 trillion in debt, with deficits over 5% of GDP. Japan and others exceed 100% debt to GDP. This creates a debt spiral. More borrowing to pay interest, higher rates, slower growth. Why ruthless? Because it's addictive. Politicians promise everything: defense hikes, subsidies, green energy, without cuts elsewhere. In communism or Bolshevism, central planning amplifies this. State control means printing to fund 5-year plans or collectivization, ignoring market signals. But it's not just there. Capitalist nations do it too, like the US with Vietnam or recent stimuli. The result? Inflation erodes savings, hitting the poor hardest. When it runs wild, hyperinflation destroys economies. Look at the patterns. In Weimar Germany 1923, war reparations led to printing presses running nonstop. Inflation hit 29,500% monthly. A loaf of bread cost billions of marks. People burned cash for heat. Hungary in 1946 was worse. Prices doubled every 15 hours after World War II devastation and Soviet occupation. They issued a 100 quintillion pengo note. Zimbabwe in 2008 to 2009. Land reforms and sanctions caused 231 million% annual inflation. A beer cost trillions. Venezuela recently. Oil price crashes and mismanagement led to millions% inflation, forcing people to barter or flee. These aren't flukes. They're what happens when governments lose fiscal discipline. In 2026, warnings are everywhere. IMF says debt could hit 100% of GDP by 2029. Advanced economies have century-high debt, with little restraint. Protectionism, AI bubbles, and geopolitical tensions add fuel. If a major economy like the US hits a debt ceiling crisis or defaults on payments, it could trigger global meltdown. Even without that, sluggish growth, projected at 2.7% globally, stifles jobs and innovation while debt servicing eats budgets. The analysis boils down to this: IOU Nothings enable short-term fixes but long-term disasters. Markets decide real value, not governments. Laws banning gold holding or forcing fiat acceptance fail because people turn to alternatives: jewelry, coins, even cryptocurrencies now. Theories overvaluing fiat ignore supply and demand. Overabundance leads to worthlessness, like the continental dollar in the US Revolution. Let me share some key quotes that capture this. From Historical Insights: if enduring store of value money must be a commodity, it follows that governments and central banks cannot create it. That's the crux. Fiat is endless, but trust isn't. Another: bad money has driven good out of circulation, even among central banks. Think about gold sitting idle in vaults while paper flies. And on demonetization. To demonetize gold, central banks would have to sell all holdings, but that would be inflationary, driving bad money to chase good out. Finally, in the world's marketplaces, will these new kinds of money hold their value against goods and services? Most particularly, against store of value money like gold. Wrapping this up, I'd say think hard about protecting yourself in this system. Diversify into scarce assets. Gold has endured for millennia as a hedge against fiat folly. Stay informed on government budgets. Demand accountability. The world doesn't have to crash, but without discipline, it might. Help navigating this crazy economy. Stay aware. Stay free.